Hello, and welcome to OnPoint, a podcast by Oak Street Funding, where we sit down with industry leaders to bring insights to the topics that you want to hear about. I'm your host today, Alex Weaver, VP of Strategic Markets here at Oak Street Funding, and let's get on point. Today I'm joined by Chris McAtee, President of INS Capital, and today we are going to be discussing financing for insurance M&A. We'll touch on what makes a good potential buyer or seller, different financing options, how to prepare for a transaction, and more. Chris, thank you for joining me today.
Yeah, thanks for having me, Alex.
Yeah, absolutely. So to start, what trends are you seeing in insurance industries as they're approaching kind of financing, mergers and acquisitions, and different types of financing structures that are most common in agency M&A?
Yeah. I don't think there's been a big change in trends overall. I mean, there's been a big one of private equity. It's no secret. It's coming
Yeah,
into the space and really drove valuations up the last 5 or 10 years. But as far as how most agents would finance deals day to day, it's still pretty much the same for the most part. It's going to be a combination of a little bit of cash, some sort of seller note
hmm,
involved, and then bank financing usually
gotcha.
most of the time. We don't see, maybe in the past, I would have seen a lot more seller financing. Right now, just how competitive the marketplace is, they don't really have to do that.
Mhm.
So, usually we would see, as far as the structure wise, that the seller is going to get 70 to maybe 85% upfront and then some sort of seller note. Now, when they're selling to larger private equity type of companies, that seller note might come in the form of equity that they're rolling from their own company into the parent company
Yeah,
of the new buyer. There's some pros and cons there. Some sellers like that because that growth in equity from the private equity company usually can outpace what that seller could do
true.
on their own.
Yeah,
But there's some cons to that. It's not liquid. They don't
hmm,
know when exactly they're going to be able to
yeah,
get that back. There's some security if you do an old, more traditional type
hmm,
of seller financing where, hey, I'm going to pay you 20% at a 5% rate over 10 years.
yeah,
And you've got this sort of monthly payment
hmm,
coming. But for the most part, outside of the valuations going up because of private equity companies pushing those things up, it's pretty much stayed the same for the most part.
gotcha. Yeah, and I think with that seller financing too, as those purchase prices keep going up and up and up, they don't want to hold 100% of it from a seller financing perspective
Yeah.
as well. So they want to get at least something up front,
Yeah.
I think, to kind of, wet their whistle a little bit.
Yeah.
So
Yeah.
giving us that overview, what are some key factors that you look for to determine if an agency is a good candidate for M&A? How do agencies typically determine if they're ready for an acquisition or a merger?
Yeah. So you kind of got a buyer and a seller
Mhm.
angle there. I'll start with kind of the buyers first. We're actually working on some stuff at INS on kind of trying to gauge or come up with some scoring metrics for buyers. Are you ready to
Mhm.
acquire? We get a lot of calls from people that a great opportunity has fallen into their lap and they're not ready.
Yeah.
And it's there's some common things that happen that we try to get to buyers in advance.
Mhm.
Like, one is your own house in order. If it's chaos and you've got staffing problems
Yeah.
and your profitability is down, it's you're not in a good spot then
Yeah.
to take advantage of that acquisition
Mhm.
opportunity. So the profit margin of the buying agency, if you can get that into a good spot in 25-30% kind of
Yeah.
consistently, again, you got your staffing under control. So if I come in and I buy your agency
Mhm.
and I'm working 80 hours a week in my own company,
Yeah.
there's, that integration is going to take a little while. So when I'm pulling myself out of my own company to try to go and work on that
Mhm.
integration, who's taking that back end?
Yeah.
That and, we see kind of like a deal team that we call it
Mhm.
for buyers. So you're running an agency day to day. Maybe you've done a few acquisitions,
Yeah.
but if you're competing in this marketplace and you don't have an investment banker, M&A advisor to keep you in the loop on what the trends are and what the pricing is, a good insurance lender, and a good insurance M&A attorney. We've seen a lot of buyers lose deals because
Mhm.
they just don't have the most current data and don't have a
Yeah.
good deal team around them.
Gotcha. Yeah, no, and I think all those are really great things to take note of. So how from an insurance agency acquisition, how are they typically financed? What financing options are we seeing that are, the most common and are maybe kind of growing in the M&A space?
Yeah. So we'll do two different types of deals. Some of the larger ones have, private
Hmm.
equities involved. People see multiples that are thrown out and they're
Yeah.
pushed out for a reason. What they don't understand a lot of times as sellers is, let's say they're looking and they're going to sell for 10, 12 times,
Hmm.
pick whatever big multiple. They think that they're getting cash at closing. Yeah, that's not the case. As far
Yeah.
as the financing from that, they might get 60, 70, 80%, but frankly, the bigger the multiple goes, the more those buyers shift into stock in the parent company. So they might get 60, 70, 80% in cash. The rest is stock. There might
Mhm.
be an earnout component after that. If you get more into smaller regional type of deals and you're looking at financing, again, that kind of gets into more of a traditional sort of setting where hey, they're going to get 75% cash at
Mhm.
closing. That bigger buyer's using a source of their own cash and, bank financing to get the cash at close. And then there might be, again, a seller note. Maybe that's paid out over 3, 4, 5 years.
Mhm.
Some people will hold funds in escrow, and if you've retained most of your commission, we'll pay that out a year from now. But it's usually all cash, and then it just varies how much do you get at close, and
Yeah.
then what series over time are you going to get that
Yeah,
the
no,
rest of it.
and I think we see that a lot too. Obviously from our perspective, we love to see those seller notes to keep some skin in the game from the
Yeah.
sellers to kind of make a lot more. I would say kind of everyone's on the same page where
Yeah.
the buyer's getting a little bit more buy-in from the seller, and the seller obviously kind of has the opportunity to stretch out that money so they're not just getting a huge windfall at one time too. So it's
Yeah.
kind of mutually
You
beneficial.
create alignment. A
Yeah.
lot of times we'll see to additional earnout payments on top
Hmm.
of the guaranteed portion. So if a seller, one thing that we've seen kind of a change recently with the valuations going up, buyers don't want sellers out immediately. They want some transition
Yeah.
time to usually at least 3 years, 1 year to help integrate the business into
Hmm.
the buyers. Ideally, year number two, they're both growing together while the seller is still there. And then the third year, it's kind of the off ramp to
Yeah.
start passing some of that stuff off. And if they can hit certain growth goals, it's beneficial for the buyer and the seller. There might be some extra payment
Yeah.
that's made on that earnout, which I usually joke with our seller clients that the buyer would like to pay you $1 billion because it meant they made two.
Exactly.
So
Yeah.
it's
No.
creating that alignment that you're talking about.
Definitely, yeah, and that alignment I feel like is so key, especially for people who are kind of serial acquirers or things like that are trying to do that because it's like you said, if they're 100% in their business and
Yeah.
having a little seller that can kind of help with that transition if they're especially doing another acquisition, it kind of
Yeah.
takes a little bit of stuff off their plate too.
Yeah.
So,
It's rare to see 100% financing.
mhm.
In the cases where we see that, it's usually a fire sale situation
Yeah,
to say that under normal circumstances, a company's worth $2 million. They're selling it at the time to a buyer that either is getting a great deal and buying it for 1.5 million or even less. So it one of two things. It might actually be worth more money,
mhm.
or again, there's some extraordinary circumstances. It's a fire sale and it's just get out now. But
Yeah,
traditional agencies that are solid companies that are selling is very rare to get just 100%.
gotcha. So, what are the key challenging factors that agencies really face when trying to figure out what the best financing structure and partners are going to be for kind of their own situation?
The biggest one, and I've been in this world for 20 years, on the lending side before, and then on the more the M&A
Mhm.
side, really in the last 10, but is not understanding how key having a lender that understands that industry is, whether it's insurance, it's CPA, it's RIA. It's an intangible asset that traditional banks don't understand.
Mhm.
And we've seen a lot of times, and it's usually maybe smaller deals or even for larger agencies that don't have a ton of experience
Mhm.
in M&A, that they've got a great relationship with a local banker. They've known him. They went to high school, college,
Yeah.
whatever together. And they're telling them, hey, Alex, it's going to be no problem. We're going to handle this. But you get into underwriting. We actually have a transaction like this right now where we've got a seller really good friends with the acquirer. Acquirer wants to use their local bank to get financing. We kind of warned both of them
Yeah.
about that. That hey, we don't want to tell you where you have to get your
Yes.
financing, but it's going to be tough for them to get it done. And we're 90 days into a process right
Mhm.
now, and we're not getting approval back from the bank. What
Yeah.
ends up happening is your traditional lenders don't understand insurance. There's not a factory of widgets
Yeah.
or real estate that they can turn around and sell if something
Yeah.
goes wrong. So the requirements in underwriting are a little bit different.
Mhm.
That's the biggest thing that we see. If it's not an insurance industry specific lender, a lot of problems come in from them just not. There's leverage ratios and underwriting
Yeah.
requirements that those front end bankers, while they might mean well, they just a lot of times can't get that done on the back end, or they have to bring in personal collateral.
Mhm.
So they might close the loan, but then your home or your commercial
Yeah.
property or something. So you're doubling up the collateral that might be needed to get the loan done.
Yeah, and I was gonna say, I feel like a lot of times we see where maybe a bank can squeak out that first small deal, but then as
Yeah.
they're kind of go back and have a little
Yeah.
bit more leverage that they need to get, they kind of almost outgrow their local bank,
Yeah.
and then they have to restart over with somebody else when they should have just kind of gone to somebody
Yeah.
that had a lot more alignment on the front end,
Yeah.
basically.
And if they would have done it early, the
Hmm.
relationship is there and it's that much easier to just get deal number 2, 3, and 4.
Yeah,
Yeah. Whereas you're
exactly,
starting over kind of fresh while you're getting
exactly.
momentum as a buyer. And
And then they're trying to backtrack to what your previous deals were and things like
yeah.
that as well. So,
Yeah.
and then are there any specific metrics or financial benchmarks that buyers and sellers should really focus on when they're in these M&A negotiations?
Yeah. I'd say for both buyers and sellers, we see problems with them overestimating like EBITDA or,
Hmm.
for we'll call cash flow.
Yeah,
We'll do a lot of work with buyers and consulting on acquisitions again. Hey, what's this worth? How
yeah,
should we structure it? Doing some underwriting with them. And 9 times out of 10, they're very optimistic. It's a
hmm,
great acquisition opportunity. And hey, I'm not going to need this staff member or consolidate these locations. Or they spend too much money on marketing. What they tend to do is inflate that EBITDA and cash flow. So they're banking on, say, hey, I'm going to buy this $1 million revenue company. I'm going to have $400,000 of profit to pay the bank debt. Well, they get into it and they forget the seller's computer systems are outdated. Hey, this person really was about to retire that you didn't know. They were making 50 grand and you've got to replace them at 75. So
yeah,
they tend to overestimate what that cash flow is going to be
hmm,
and can get in trouble then post closing. Or frankly, when it comes time to get the financing, a bank's going to come in and underwrite that and
yeah,
maybe not agree with their projections. Same thing on the seller's side. They will look at that and say, hey, you don't need this, you don't need
yeah,
that. Our profit margin has been 20% year over year, but all of a sudden now it's 50 because they know now there's enough information out that agencies are selling for a multiple of EBITDA. So we have conversations
how
every
can I
day.
inflate my EBITDA as much
Yeah,
as I
you
can
take
to set
this
up?
out. I
Yeah,
was making 200 grand before. I'll work for $50,000
hmm,
now, and so you'll get sellers then that place their pricing expectations on unrealistic projections. The same thing as the buyers.
yeah,
So a lot of times we get brought back in from a consulting perspective on, hey, we've got this deal. Either the bank turned us down, or we'll be talking to a seller that says, hey, my company's worth $10 million, and we've got to bring them back to reality. Like, hey, it's very valuable, but your profit margin's
yeah.
off. It's really not worth that much.
Yeah, no, I think that's great insight and something we see every day where,
Yeah.
it's great to have a third party like yourself that's kind of coming in and coaching them a little bit more through
Yeah.
that. So it's not, hey, we don't think we need these expenses or we do and kind of,
Yeah.
really get into a different point
Yeah.
and how the
Because
financing evaluation is.
business owners always wait. I'm guilty of it myself. I
Yeah.
probably don't spend enough time on my own business
Hmm.
that I should on things I know I should look at. But planning ahead a little bit, either
Hmm.
one from a buyer and two from a seller's perspective, is if you've got some target date that you're going to retire and you're banking on the wrong sorts of expectations or the
Yeah.
wrong multiples, there can be a compounding factor that
Hmm.
you've put your profit margin too high. It's 10% lower, and you thought you were going to sell for a 12 multiple and it's really 10.
Yeah,
I mean, that could be $1 million mistake, and
for
all of a
sure.
sudden you're finding that out at 67 when you're ready to go.
Yes.
You're either taking a lot less money or working a lot longer.
Yeah. No, and I think that's great insight for these agencies as they're kind of trying to, I think the industry is getting more and more proactive, which I think is great. I think, as it continues to grow, we're seeing more people really have that forecasting and work with people like yourself to prepare
Yeah.
themselves more than kind of just waking up one day and saying, "Hey, it's time
Yeah.
for me to retire. What can I
Yeah.
sell my agency for?" So at INS Capital, I know you guys have a lot of experience in helping navigate through mergers and acquisitions. How do you help agency owners really assess their borrowing capacity and find suitable, different financing options?
So we were talking a little bit maybe preparation for sellers,
Mhm.
but on buyers, again, we're kind of working on some metrics and almost like a checklist and a guide to buyers to help prepare themselves. So we'll get in. There's a couple of different ways as far as consulting with buyers. Ideally, we talk to them before that an acquisition opportunity happens.
Yeah.
You get in. Again, a lot of the INS team members have background in banking. That's where
Mhm.
we all started. So we would get in with the buyer and we can look at their revenue, their cash flow, and kind of we know what the bank underwriting process is going to
Yep.
be like. So we can look in advance and give them an idea on what their capacity is. So based on your revenue and your cash flow or EBITDA is X, you should be able to qualify for this amount of
Hmm.
financing. So it's almost, you think of it kind of as a line of credit or
Yep.
again capacity to get out and acquire. Or we can look at certain things where, in the business you work really hard, you take all the money out, there's no profit. Well, if it's not there now,
Yeah.
you're not going to have that ability to get in and borrow against it in the future. So, and just helping them to understand how the bank eventually is going to look at it.
Yeah.
And again, the preparation, you don't necessarily have to do it, but
Hmm.
you're going to bank a little bit on getting lucky when those great opportunities come in. We've had that just dozens of
Yeah.
times over the years where you've got a deal, there's an agency that has an opportunity to acquire something down the road. The marketplace is really competitive. They're not going to buy it for 2 times revenue
Yeah.
anymore, and they haven't done the right things in advance to prepare
Mhm.
themselves. And getting out and getting a valuation, that's a metric that banks look at. You're only going to lend
Yeah.
a certain amount of the loan to value on that, and you're going to look at the cash flow. So understanding that stuff beforehand, and then even getting pre-approved by a good insurance lender does a lot to put them in the right spot. If we have a seller client and we've got maybe an independent buyer that's coming in and they tell me that they're going to use their local bank, or they're not pre-approved with an insurance lender,
Yeah.
they've never done anything before, we're not going to take them realistic
Yeah.
because there's 10 other buyers that have all that stuff done, that have done the prep work in advance.
Yeah,
Um,
exactly. Like you said, with how competitive it is, really doing anything you can to set yourself apart
yeah,
from those other offers, or trying to get as much alignment or as much
yeah,
confidence that the offer will go through, I think is a
yeah.
major key for those sellers,
And it's,
especially.
if somebody's done one acquisition or two or three, and they did it even 4 or 5 years
Hmm.
ago, just the competitive landscape is changing. So just getting in, one of the things we try to do with buyers on kind of like a consulting, and it might be like a block of hours, something that's not super expensive, but get them in up front. Like
Yeah.
if they're competing with large private equity buyers or public buyers, they have teams, dozens of people
Yeah.
like us that they're competing against. So as an agency owner, you don't do that every day. You're not
Hmm.
supposed to know all the little tricks and tactics and key underwriting metrics and how to structure a
Yeah.
deal. So getting a professional advisor, you're looking at a multi-million-dollar deal.
Mhm.
You're going to have an attorney, you're going to have a CPA, get a deal guy involved to help increase your odds of actually getting the deal done.
Yeah. No, I think that makes a lot of sense. And when you're helping these agencies assess their capacity and financing, and that's often cited as kind of a major concern for them as a real differentiator. How do you help them structure the deals and really structure the funding they need, whether it's that seller financing, how much upfront? Those earnouts especially, I feel like are kind of a hot button topic as these multiples kind of grow, and then how much alignment those sellers have after the fact as well.
Yeah. Again, so specifically for us, with just the background as bankers, um, we get in either with a buyer or seller. And we look at that situation and figure out again the revenue, EBITDA of both sides. Figure out what the purchase price is. They'll usually come to us. I'm going to pay 2 times or 3 times or
Yeah.
whatever it is, and then we will go and vet that up front and say, okay, hypothetically, then we've got something in some of our engagements we call an acquisition feasibility
Okay.
test. Great, Alex, you're going to go buy this agency. Let us see if it actually works.
Mhm.
We're going to go and kind of stress test that against the bank underwriting metrics
Okay.
to make sure that if you get in and spend a bunch of time with the seller and you tell them that this is what you're going to pay them, that you should actually be able to deliver on that.
Yeah.
And if we can catch it far enough in advance, again, you have some tough conversations, but
Hmm.
we would rather both a buyer and seller understand what's going to work up front before you sign a letter of intent, before you go through months of diligence and legal
Yeah.
stuff. It's a stressful time for everybody. There's a lot riding on it, often
Hmm.
millions of dollars. Set the deal up correctly. We were talking about alignment a little bit before and earnout potential. So if we're working with a buyer, we might look at that says something, hey, you can't pay quite as much as what a private equity company can,
Hmm.
but here's where your advantages are. And to help bridge that gap, maybe we look at some sort of earnout payment or um, acquire portions of the company over time. Again, depending on the type of buyer and the situation, we can give them tips on what we're seeing in the marketplace every day to help them be more competitive. And the same thing with the seller. A lot of our seller clients might come in and say, hey, someone's going to pay us X, Y, and Z.
Yeah.
And we're like, hey, that's not going to happen. What they're
Yeah.
hoping is to get you under a letter of intent, kind of maybe not maliciously drag things out for a little
Yeah.
while, but hoping that you get emotionally committed to the deal and they can come back at the end and say, well, actually, my bank says I have to do this.
Yeah.
We would help them know that upfront, or at least vet that before they start that month long
Yeah, so it's not a
process.
surprise at the end of it.
Yeah.
They're kind of scrambling before the finish line,
Yeah.
basically. And so, how do valuation methods for these insurance agencies really differ compared to other industries? And what makes the agency valuation process so challenging?
Agency valuations have risen quite a bit over the last few years. It's a lot different than a manufacturing company
Yeah.
or a software company or a tech company. So having good kind of, comps on
Hmm.
what agencies are selling for, what peer groups have recently sold for, it's really hard to find. It's all private data. We've been doing this for a long time and have a list of hundreds and hundreds of comps to go through there.
Hmm.
So being accurate with that stuff, is huge. What we see a lot of time, again, not understanding necessarily realistically what your margin is.
Yeah.
We will see sellers overinflate that margin, or again, read an article or type into Chat GPT,
Yeah.
something like that that says agencies are selling for X,
Hmm.
10 times or whatever. And everybody tends to probably overestimate, the
Hmm.
value of your own company. It's,
Yeah.
you don't see the holes in there, or again, the changing and different sorts of
You see
trends.
the pie in the sky purchase price that
Exactly.
you want to set up for,
You built it the way that you
Yes.
wanted to. So we see a lot of times, and it's usually with sellers that are a little bit later in their careers that,
Mhm.
hey, I heard somebody sold for this,
Yeah.
but they don't understand that it wasn't all cash. There was an earnout to that, or maybe stock appreciation from the seller. And frankly, the next 10 years are not going to look like the last 10 years.
Mhm.
Interest rates are higher. Capital's not quite as available. There's still plenty of buyers out
Yeah.
there, but things have tightened quite a bit. Um, Buyers are really starting to underwrite deals a little bit more. So as far as another things that we see the business owners don't understand, there's actually a few different types of valuations that you could do.
Mhm.
We do something that's called a limited scope valuation, which is kind of a quick and dirty estimate on value. If somebody just needs something done quick, we do these for banks. We'll do these for buyers and sellers that already kind of have a deal together
Yeah.
and they just want to know, hey, let's get something fair. Give me an estimate on
Mhm.
something like that. Then you've got a fair market valuation, which is a more formal type of process that needs to be done. These are done for banks, for loans, for life insurance, estate planning, tax purposes. There's certain metrics that you have to follow in doing that. You have to compare that company to public companies,
Mhm.
do discounted sort of cash flows and things like that. Those valuations tend to be, it could be 15, 20, 30% less than the street value of the
Yes.
company. Somebody's going out into the marketplace and there's a competitive bidding war or multiple acquirers that tends to drive a price up. So we also do something we call a strategic market analysis, which is the third type of valuation. And you can kind of customize these things to say, if you sell internally, if you sell externally, here are kind of prices and ranges.
Mhm.
It's kind of like life insurance.
Yeah.
You can buy term life, you can buy whole or universal. There's
Mhm.
different types of valuations that you can use for different types of purposes. And they
And,
can range 20, 30% sometimes.
yeah, I think that's great too because we are seeing more and more internal succession planning and understanding kind of what that's going to look like versus
Yeah.
kind of the free market, which, like you said, maybe you have more alignment with an internal seller, and so it's a little bit easier of a process. So maybe you're willing to give a discount versus obviously if you're going external, you're kind of dealing with whatever factors are coming from that external buyer as
Yeah.
well. So, can you walk us through a recent deal that you maybe made that was successful, or what unique challenges you might have incurred with a recent deal as well?
I think we talked about it a little bit earlier, but a couple that come to mind. One specifically on like a financing front. So we've got a seller client. She knew a local buyer that she wanted to deal with, very close. Friendly competitors
Yeah.
over the years. It's always kind of who she thought she was going to sell to. We had talked to that buyer. The price is fair. We'd negotiated everything. That buyer wants to use a local bank. So again, we'd had the conversation about you can go through and do that. This is probably the likely pitfalls that you're going to come
Hmm.
into. We try to underwrite a little bit on the buyer to make sure that they're financially qualified up
Hmm.
front. And he is, but we knew it was going to be tight. For a local lender, he's kind of hitting those
Yeah.
capacity limits that we had talked about earlier. So we're going through that process, and exactly like we thought, that local lender's having problems. They haven't turned the deal down, but it's taking 2 and 3 times as long to get it done.
Mm.
So we had talked to the buyer up front and the seller that, hey, we don't want to force a specific lender in here,
Yes.
but if problems happen, we get so far into the deal, you've got to go to an insurance lender as well, just as a
Yeah.
backup option. So that is playing out right now as we speak. So we've been able to
Yeah.
bring in an insurance specific lender that is now going to close the deal probably in 30 days,
Hmm.
whereas the local lender's taking 90.
Yeah. And
So
still working on it at
yes,
90. Yeah.
yes, exactly. Haven't turned the deal down.
Yeah.
Let's say another transaction that we've worked on. We did a valuation for an agency a couple of years ago, and there was going to be internal perpetuation. They had started that process a little bit. A kid was taken over for the parents, and I think the ownership might have been 60-40 at the
Okay.
time we had done a valuation. And the parents were finally, they were ready to retire, and basically sell, the rest of the company.
Yeah.
The younger generation that was coming in essentially just kind of decided that, hey, we don't want to take on that much debt. All right. It's not
Yeah.
necessarily right for us. We're not sure what we need to do now. Dad needs out. We don't want to have to go through and buy everything.
Yeah.
So we were able to kind of find them a hybrid buyer option where
Okay.
they could keep equity in the company, but an outside buyer came in to acquire dad. So
Gotcha.
dad was able to get the money that was needed to retire. And we had done a lot of planning with that company over the years. So
Hmm.
again, if you get out in advance of it,
Yeah.
get a valuation, you understand what the value of the company is. It's less if you perpetuate it internally
Hmm.
than it is externally. But if you know that in advance, you can save a little bit more and make some tweaks years
Yeah.
ahead of time if that's your goal is to really perpetuate it internally.
Yeah.
And they were prepared, and it wasn't exactly like they thought it was going to
Hmm.
be. But again, we were still able to find a situation
Mm.
where dad was able to get out, get a fair price to get out of the company. The kids are involved, still running everything day to day, still have some equity. So everything ended up working out.
Yeah, I think it's great that that planning really allowed them to maybe not get to the end solution that they really thought on the front end, but still
Yeah.
one that, is amicable for all parties and everyone kind of leaves happy,
Yeah.
basically. So we talked about a lot of quantitative factors that you analyze with these deals, but what about qualitative factors? So we're looking at culture and things like leadership transition that play into, especially as these deals kind of get larger, you know, different M&A opportunities.
Yeah. And the two things kind of merge together. So specifically when we're talking to our seller clients together, they're looking at the numbers and the price and
Hmm.
everything. But again, when you get into the qualitative factors, culture, leadership transition, those sorts of things, when a buyer looks at those and everything lines up, and let's say a seller wants to get out of the business, if they've done a good job on creating a deep bench behind there, again, there's not necessarily a number that you can put on that,
Yeah,
but that lowers the risk profile for the buyer. That
definitely.
hey, once that leader and that visionary that started the company is out, there's a good team that's there. That's going to push your price up.
Mhm.
So buyers look at that quite a bit on cultural fit. Again, I'd say that's probably maybe one change that I've seen recently. Now between 3, 4, 5 years ago, buyers might get in and they might not, frankly, some of them weren't doing a lot of underwriting.
Mhm.
So, hey, you've got X amount of revenue. Here's the price. We're going to buy you. We
Yeah.
don't really care what's going on. Well, now you're 3, 4, 5 years into those deals. And if that company selling in or the team that's coming into that buyer's operation is not going to be a good cultural fit,
Mhm.
they're finding out now. And it's
Yeah.
a problem. So you've paid a lot of money and big time investments into this, and now you've got big issues up front. So we're seeing again buyers try to really make sure that they can get in, take time to talk to the people, get to understand them ahead of time. The numbers are going to take care of themselves for the
Yep.
most part. So yeah, when we run our sell side processes, we try to make sure that there's ample time that people get to meet face to face, that you
Mhm.
have dinner. If you need to talk 2, 3, 4 times, they can get in there and do that and really understand it. We want our sellers to, as they get towards the tail end of a process and they're trying to decide which route they want to go, take the economics out of it. Who do you feel the best with? Who do you want to
Yeah.
sit down and have a beer with? Or, you're going to be partners with these people for a while.
Mhm.
Just, usually we find, especially through several conversations and months of a process, you start to know, you just kind of get a feeling like that. And, we would try to advise them, don't just chase a few extra dollars
Mm.
because Uncle Sam's going to come in and take his cut. You might have partners. You got to put a certain amount in for retirement. And if you just chase the money and don't look for that cultural fit, you're going to be miserable in 6 years.
Yeah, it'll be like pulling teeth trying to make something work that wasn't really meant
Yeah.
to work the
Yeah.
whole time as well. So what advice would you give to an agency owner that's, just beginning the process or thinking about M&A financing or, how they're going to grow by acquiring another agency, what would kind of be your initial thoughts to someone that's just starting the process?
First and foremost, start that relationship with an insurance lender.
Mhm.
Get out there, see how much you will qualify on your own, start to tell them what their plans are. One, those banks might get tips on acquisitions
Yeah.
that they can tee you up for. Um, you don't necessarily need to go in and get a valuation on your own company, but again, we try to do a lot of work with buyers up front to prep them. Here, these are the market prices. You might need a certain amount of cash down. Again, going through those types of metrics that are going to make you more competitive as a buyer. We'll give people advice on where to start hunting and finding
Mhm.
agencies. We get a lot of calls that say, "Hey, Alex, I want an agency on the west side of Indianapolis, and it needs to be this size."
Yeah.
Great. There's like two of those, and I'm never going to find them.
Yeah.
But um, you can get in and talk to marketing reps, or here's certain websites, or here's some cold outreach and some
Mhm.
tips to be competitive, to actually get the opportunities. And then where we really try to get in is trying to say, okay, can you afford a $500,000 acquisition at 2 million? What does that look like? Here's the payment. Here's the interest rates. Making sure that they're prepped and prepared in advance. But I'd say the biggest thing is just, again, understanding who you're going to go to and who that deal team is, um, the bank, the advisor, they're going to help you when that opportunity comes up.
Gotcha. Yeah, I think the more proactive people can be, the better, just to kind of give themselves resources, or like you said, set themselves up as they're going through this for the first time, where it's a really big thing for a lot of agencies when they haven't gone through it before. So
Yeah.
that extra education's a big
Yeah.
differentiator.
And if you're in a competitive situation, you're not going to get time to learn on the fly. Like, so if you don't know what the pricing expectations are, you don't have stuff ready to get to a bank to get your pre-approval done. When you find out about that acquisition, especially if it's a competitive type of process and that seller has an advisor involved, there's a window, probably 2, 3, 4 weeks where you have to throw your hat in the mix, and it's got to be competitive. And if you're
Yeah.
trying to analyze the risk and you don't have your ducks in a row, you're out before it even got started.
Yeah. No, I think that's great advice for, any agency that's really looking to get into it, whether they've experienced or not. So to wrap things up, looking ahead, what trends do you kind of foresee in the future as we kind of move forward with, insurance and agency M&A?
Yeah, I think the acquisition flow has slowed down a little bit over the last few years. I don't think that's an indictment of, the market shifting. I think things got really crazy and really aggressive in like
Yeah.
2021 through 2023. So we're seeing a little bit more of kind of like a normalizing. There was a
Mhm.
spike, now it's back down and things are starting to level off. You still got a ton of business owners, insurance, and I'm sure other industries
Yeah.
too. It's baby boomers. They're going to have to transition those companies. So I think as far as the number of acquisitions, I don't see that falling off. Again, kind of normalizing
Yeah.
and leveling out. There's still a ton of private equity in, valuations are up. We're seeing some adjustment, not necessarily that prices are coming down dramatically, but some things that we saw 3, 4, 5 years ago where those sellers could put together a projection at a 50% margin and get that 10 times multiple.
Mhm.
That's not happening today.
Yeah.
The buyers are getting smart enough that, hey, this isn't going to work for us long term. So there is kind of some downward pressure on some of the pricing. If you're not growing, you're not going to go out and be able to project out a really high profit margin and get a buyer to pay you
Yeah.
that same multiple. It's not happening. Buyers are getting smarter, so the sellers need to do work in advance if they still want those really high multiples. But there's still a ton of demand. There's a lot of activity. We've seen people um, intrigued by the private equity option, but more and more people starting to say, "Hey, maybe there's another route. I'd really like to perpetuate this
Mhm.
internally." And if they start far enough in advance, that's another option. So I think the activity is going to stay there. Don't see a ton of pressure really on prices, but some of the, I'll say, just more outlandish multiples or, buyers just acquiring anything with no
Yeah.
underwriting and discipline, that is changing.
Mhm.
So there's been some downward pressure on some agencies and prices.
Yeah, I think the nice thing too is, as we've kind of seen a softening in the rate market too, it's a little bit easier to get that financing. You're not paying, extremely high interest rates as
Yeah.
they kind of tend to drop, which will drive valuations up a little bit just because people have
Yeah.
more appetite for financing, but also make those acquisitions a little bit more affordable for those agents that kind of go the bank financing route. Well, thank you for being here. I know I learned a lot. I'm sure our listeners did as well.
Yeah. Thanks for having me, Alex. I enjoyed it.
Yeah. And thank you all for listening to On Point, a podcast by Oak Street Funding. I'm Alex Weaver, and tune in next time when we sit down with more industry leaders, wherever you're listening to podcasts as well, to get on point. Don't forget to rate and review on Spotify, like and subscribe on YouTube, and follow us on Instagram for any insights and behind the scenes content at onpoint.osf. See you next time.